Hello and welcome to this edition of The Global View. And today we have with us Jim O'Neill, former chairman at Chatham House, former chief economist at Goldman Sachs, and also the former commercial secretary at the UK Treasury, joining in the show right now. Jim, great to have you on ET Now. Thanks as always for your time. Jim, the new reality for India is the post-tariff regime. A 50% tariff has been slapped in India as of yesterday. Do you think the equity markets were somewhere working with that assumption? And to a large degree, would you say that it's in the price when it comes to India?
Wow. That's quite a belief. I'm still trying to get used to it. Just listening to you summarizing the new reality, or the reality for the moment, is still quite hard to comprehend. Who would have dreamt back in February that this is where things might have settled on tariffs for India? I remember speaking to some Indian diplomats following Modi's visit, and they certainly would not have expected anything like this. So I find it hard, to be honest, to think that the equity market's price has factored this in. Although I very quickly add, I'm not quite sure whether I'd say that for global equities either, partly because of the remarkable ongoing story with AI and everything to do with it, particularly Nvidia, and obviously we're speaking a few hours or 12 hours after their earnings. The equity markets globally seem to be quite relaxed about the reality that Trump has effectively now imposed a very significant increase in tariff rates with the average of all America's trading partners, India amongst the worst. But I'm not sure that I'd describe myself as feeling as relaxed as the equity markets seem to be, either in India or elsewhere, to be honest.
But Jim, I recall in March you were of the opinion that for the rest of the decade, US is likely to underperform the rest of the world. Not on its own feet, but perhaps because the rest of the world is looking much cheaper. Does that view still hold?
I'm glad you recalled that, because I did say that. And I think because of, to be honest, virtually every day I wake up and read yet more news about Trump-led America, the more I think that this is the decade of outperformance of the rest of the world's markets, both including a quite likely further decline in the dollar, which typically always helps, especially the so-called emerging world, but also in this case elsewhere, because I think he is doing things that both undermining many of the past strengths of the US economy, almost indirectly, almost feels like deliberately weakening the US consumer, and more substantially in some ways, in terms of structural forces, weakening the institutional framework that has been part of why the US has been partly so exceptional. And this is, I think, relevant to India, and I'm looking forward to discussing it perhaps more with you, forcing other countries to think differently about where their alliances are and what can they do domestically and or with other trade partners to reduce their importance of the United States. And you can see that clearly going on in Europe with Germany. And of course, I would have thought there's some more interesting conversations going on between so-called BRIC members than there might have been a few months ago about trying to take some of their own relationships to be more powerful than they have perhaps been in the past.
For instance, even the India-UK FTA signing also clearly is a sign of that, right? But Jim, the fact is that...
Perfect example.
Yeah, absolutely. But all of this is going to take time, right? For us to find newer trading partners and not have all our eggs in one basket, or for that matter, concentration to economies like the US. That transition will take time. And equity markets will be quick to price that in much earlier. Do you think equity markets world over have already begun pricing that in? That concentration pool from the US is going to shift to the rest of the world?
I think to some extent, and linking it to your first quite astute question, I think that has been happening. I remember thinking, even before Trump got to Liberation Day, we'd seen this outperformance of some parts of the world, notably Germany. And I think that was in anticipation of the Germans shifting more on policy that turns out to be right. And as you've said, equity markets are very good at thinking about the long-term change of direction. So I think to some degree that is happening, and that's why other markets are coping reasonably well. If it were just those aspects of tariff policies, and there weren't other related to some degree, but also separately other issues going on, particularly uncertainties about inflation and interest rates, then I would have a lot more confidence that the rally that we have recovered from since the spring in US-led global equities would continue. But I have concerns that the pressure that's being put on the Fed by Trump is going to clash at some point with the underlying previous legislated requirement of the Federal Reserve to try to keep inflation as low to 2% as possible, because the underlying inflation signs aren't that good. And probably the most striking thing in the past few weeks is a similar sort of message in a number of other so-called developed countries too. And so that is lingering as another issue, that it feels that both bond markets and equity markets are, let's just say at the moment, being quite hopeful about where those things might settle. But I see some signs of some concerns there myself. But it may well be that it is just this power of the equity markets to see through all of this and looking for different global rotation, and for the likes of India to prove itself yet again as being a domestically driven economy and market, and that we have more other economies in the world that are will become more domestically driven too. I don't dismiss that as a possibility, and on one level that would be a very healthy thing for the world.
Absolutely. And I think, Jim, that also sort of throws up another question as to how investments across the world are going to be dictated now. Is it going to be with new trends, like what you're seeing play out in the US, with the top 8 large companies all being tech-driven? Is it going to be purely about valuations? Is it going to be dollar-denominated? Or is it going to be a pool of all of the same? Or is it really going to be about which country manages to navigate both geopolitical tensions and tariffs?
I think it's going to be all of those things put together. And I have to say, as an aside, again, listening to the way you ask these interesting questions, I think for the alpha generators in the equity world and the macro space, I sometimes in recent weeks joke to some of my old pals from my more active days in finance that it's like the heydays of the macro world are being brought back from something that almost haven't been there since before the days of the euro. There's so many issues out there to focus on, and I think it must be true for the sector and stock specific equity players as well. So for those true smart alpha generators, this has got to be a fantastic environment, I would have thought. Also a highly risky one for when you get something wrong, I quickly add. However, but I think all those factors you raised in that question are all going to be constantly playing against each other. I mean, you just look at what we had with Nvidia earnings last night that sits in the middle of of course, the AI story. I mean, quite astonishing revenue growth and seemingly never-ending plans for substantial investments. But I can't help thinking that, you know, we have seen, for those of us of a certain age, we have seen that song played out in history, and at some point, something will not be quite as good as that story seems to currently be. And I have to say that the idea that in another few years, the US stock market is going to be so dominated by just 8 companies, and for that matter, therefore, the world stock market as it is today, is very, very unlikely. And so at some point, some kind of jolt, or whether it be a positive or negative one, will shift us away from that. But obviously, for the very foreseeable future, that remains, if not the dominant theme of global related markets in equities, but certainly very close to it. But I think in parallel, because of what Trump is doing on tariffs, what he's doing with the Fed, and his constant chipping away at the institutional structure of many different parts of the US framework, latest news being is in firing the head of the Center for Disease Control for no obvious reason, it seems to me. You know, there is going to be more and more conservative investment managers looking to shift to other parts of the world. And so those countries that can somehow not irritate this current president any further than they might have done, but more importantly, make sure that their own economy is more dependent on things under their own control, I suspect those are going to be the markets that attract quite a lot of investment, quite rightly so.
But again, you know, Jim, it's when you look, or rather hunt outside US, do you look for valuation? And is that the primary comfort segment? For instance, in March, you thought that flows are going to find their way to China and Europe. And since then, of course, these markets have been quite favored. You know, someone the other day was saying Uzbekistan is looking cheap. Do you just hunt for bottom-up stories now?
Well, you know, again, having been in and around this business for so many decades, on the one hand, as has been proven so far this year, you can't ignore valuation when some markets, whether it be countries or sectors, are more than 2 standard deviations, let's say, away from their long-term trend. By definition, they become attractive to me, and we've seen it with China, and we've seen it with Europe this year. However, valuation is never the thing that drives the specific shift. It is due to some typically policy change, and it tends to lead those markets in the opposite direction until something else new comes on the scene. So obviously China and Europe are nothing like the cheapness that they were back in February, but they're not particularly expensive either, and they're certainly not expensive relative to the US if you include the tech sector. And so I see no reason why their general outperformance won't continue. And I think as the Fed moves towards easing, and I'd put myself in the camp that the Fed is going to ease at its next meeting, I think it's probably pretty good news for many other emerging markets too. And not that I've looked at Uzbekistan recently, but I would imagine that would benefit from it as well if the Fed does go ahead and ease.
So, Jim, where does India come in this entire pack? Because India has always been an inward-looking economy. Yes, there has been an FPI exit from our market, but our domestic institutions themselves are, you know, holding the market a ship. That said, India is not cheap. It's fairly valued to expensive at best. So what's the opinion on India then?
You know, I have to say I'm torn. It's very interesting how after many, many years of India being the star of the so-called emerging and specifically within the BRICS equity markets, it's just been non-stop outperformance that in a year like this one, that has come to an end. And that's probably for the medium to long term quite healthy for India. There were many warning signs starting to grow. I don't recall, but I think we might have discussed, or I might have raised with you a piece that I'd read a few times from different outlets about just how huge the role of equity derivatives turnover had become in the Indian market, which was a bit of a classic warning sign to me of excess. And those things seem to be playing out a bit. And so I'm not surprised that India's underperformed and it's not quite the same expensiveness as it was. But again, as you pointed out, it's not cheap. On top of that, India has had a surprise shock from the outside that it's got to work through on these tariffs. I think it will be very interesting to see, linked to Modi's trip to Beijing, whether things can get closer after so many lifelong, if multiple generations of core animosity between these two huge rising powers. But I think if something on the positive side were to emerge from that, then that would be a very interesting new positive for India. On top of what you've pointed out is this reality, which I think is a natural advantage in this world where suddenly globalization is deemed so unpopular, which, as an aside, I think is sort of ridiculous. But that said, India is an economy that tends to be greatly driven by what's going on inside India, and that is definitely an advantage.
Yeah, that's the other thing, right, Jim? Because, I mean, taking a leaf off your example of NVIDIA, look what's happening in terms of a trend when it comes to both China and especially the US. When the world is moving towards AI, here you have India, which is largely a consumption-led economy, and consumption is what's doing well with the equity markets as well, and all peripheries and, derivatives of the larger band of consumption. Do you think Indian equity markets can run on that consumption piece for another decade?
I mean, why not? I mean, this goes to the core of the sort of BRICS thesis that obviously I've become so known about, really, that India's in the sweet spot of the very large populated nations that we still, quite frankly, incorrectly describe as the emerging world or the global south, but that's the simplistic phrase we use. Of them, India has a lot of the population dynamics and the later stage urbanization dynamics that play so well into that general theme. And in addition, you've got, I think, a bit more momentum on the positive aspects of being able to implement infrastructure much better than India had done in the past, which makes it easier for all these urbanizing places to function better. And that helps create more and more middle class consumers, which is what drives the potential United States of economies of the future. And India is definitely well placed for that. So long as, and this is an important caveat, we do not have a big surge in inflation, and with it a very different pattern of interest rates going forward, than especially compared to the ones that now global markets have got priced in, because the markets are expecting the Fed to cut quite a lot, and to some degree that Trump is going to get his way. And if something comes along that makes that actually not the case, then that's going to be pretty bad news for all sorts of things in the world, including many markets that are to a degree superficially insulated from the US by their own consumer. But if interest rates go up, then as we always see, at some point, it's very difficult for any equity market to compete with them.
Sure, and that's the catch point, right, Jim? Because if the chatter from Jackson Hole is to be believed, it seems like Fed is headed in for a rate cut come September. And if that were to happen, perhaps a lot of these flows, at least tactically, would move back to the US?
I'm not sure about that. I mean, to me, the key thing from the Fed September meeting is whether it's sort of one and we're done, or as was implied by the speech in Jackson Hole, that the Fed is now so concerned about the underlying slowing of the U.S. economy and the slowing of employment that the markets will assume that there are multiple rate cuts coming. And pricing more cuts than they have already, which I think is probably what's going to just about on balance happen. And I think that will lead to further inflows into other parts of the world and a weaker dollar. I'm not sure that ultimately that is going to be what actually happens, but I suspect that will could well be the mood that emerges by the later parts of September.
So, Jim, if I were to ask you, you've got $100 to invest for the next 3 months and the next 6 months. Which country and what pool of sector within the country would you be most keen to invest in?
I was hoping the line would go down before you got to this question.
I'm getting that predictable.
I have no idea. Although, given that I did have a stronger feel early this year that I thought we would broadly have the way markets have unfolded without performance of equities from the rest of the world and inflation pressures would ease. On balance, I think for the next 5 to 10% moves of markets, I think we will see more of that. But as you can perhaps tell by my reoccurring tone, is that I worry that underlying inflation is not beat, and the kind of I haven't even raised this, but the fiscal pressures that are growing in many parts of the developed world on top of this pressuring of the central banks could be setting the scene for a more genuine pickup in inflation that we haven't seen for a long time. And if that were the case, then I think one has to be pretty careful about all sorts of pure financial market investments, including equities. But for the foreseeable future, I would have the balance of my $100 in non-US equities in various parts of the world.
And if not equities, any dollar, gold, or silver?
I mean, definitely in terms of currencies, I think the euro, despite the issues that have just suddenly come up in France, I think the euro looks like it's going to get further strength as the year develops. And the one that if I had you're asking somebody that wouldn't mind taking more of a speculative bet than others, but the one currency that stands out to me as having a lot more potential to rise significantly is the Japanese yen, especially now that Japanese bond yields have started to move in the way that they have, and we've seen a significant narrowing of longer-term interest rate differentials between the US and Japan. I would have thought dollar yen has got a substantial scope for the dollar to weaken, although I would have said that to you a month ago, and it hasn't happened. So there may be something going on I haven't quite yet figured out, but it looks to me like that could be a big currency play in the remainder of the year.
Always good to chat with you, and thanks for all your insight.
Thank you for having me on as usual. Nice to speak to you. Good luck.
Okay, that's the word coming in from Jim O'Neill. Well, we also spoke with a whole host of